Megan, it's good to see you again. Let's start with the sort of whether inflation or how much will inflation recede part of this. How important is this to investing right now?
Oh, it's the single most important issue that investors are facing right now. And we are, have a very important inflation report tomorrow. We are expecting inflation to decelerate into the balance of this year. And we're hoping that at least at the core level, peak inflation is behind us. But for consumers, as we all know, food, energy are very important. So while we typically would be focused a little bit more on core and the impacts on monetary policy, headline inflation is very important. So the risks there being food and energy. But we do expect it to decelerate. Recession odds are elevated, say maybe 30 to 40% over the next year. But we still think that there's a landing strip for inflation to slow, the Fed to be on net a little bit more dovish than what the market is expecting, and the consumer to remain in good health.
So that all suggests to me, Megan, that the recession odds are rising, but it is not your base case, that the Fed may not be as hawkish as it is appearing to be right now, that inflation might be slowing, that we are closer to the end of this market sell-off than the beginning. How likely do you think it is that the stock market in the U.S. begins to turn up over the next couple of months and maybe ends the year somewhat higher than it is at least today?
Yeah, well, that's really interesting. So you raised a couple of good points, which is the duration of this sell-off. And we do think this could be a little bit on the longer side of things, mostly because the catalyst that we need in order to see the market bottom is not only inflation to peak, but to get a better sense of the pace of deceleration and whether the Fed really will be able to maybe get to a point where they raise the next couple of meetings and then slow that pace or even pause and look around. But the key is that the market tends to sniff out any changes in inflation even ahead of the actual data. You've had a number of guests and commentary on talking about how June CPI will be a little bit lagged to some degree because of the changes in gasoline prices and energy prices and how much that has changed just over the last couple of weeks. So we do expect the market might sniff that out in advance. And that's just why it's just simply not a time for investors to be taking big bets in this market. We've tightened up our positioning and we're just looking to remain diversified and find opportunities within different sectors.
So it's a dollar cost average at reasonable intervals. It's an investor's market, not a trader's market.
Well, I would say for the tactical trading point of view, we do have elevated cash, much higher than we typically would hold and that we've held over the recent years. But for investors who have had, we deal with a lot of investors who have had a liquidity event and are looking to put a large amount of money to work at a particular time. We still think it's a good idea to stick with a plan and dollar cost average in for those clients, because even if we get a recession, which is not our base case, but elevated probability, we're probably 2/3 of the way there to pricing that in. And it's very difficult to time the market and the bottom perfectly, as we all know. So getting that cash in gradually and methodically, we think is still the right way to go.
God, I'd love to have a liquidity event. That's all I want. I just want a liquidity event.